Assalamu alaikum. Welcome to lecture 20 of SBR. Today we are going to cover IAS 36, which is impairment of assets. And for your SBR, this is a standard which you are definitely going to get in your exam. Okay, so here we are going to focus on the definition. What are the indications of impairment? How do you calculate an impairment loss? How do you recognize it in the financial statements? What are cash generating units? Reversal of an impairment loss and disclosure. Okay, impairment means when there's a reduction in the recoverable amount of an asset or a cash generating unit below its carrying amount. In short, value of a asset is going down. Reduction in the value of the asset, that is the meaning of impairment. Okay, so IAS 36 says entity should carry out an impairment review at least annually. That means every year you need to carry a test on your asset, whether your asset has been impaired or not. Okay, if an intangible asset is not being amortized because it has an indefinite useful life, or when a goodwill has arisen on business combination. Let's say you have bought a subsidiary, that's a business combination, right? For that, a goodwill, there's a goodwill, you recognize a goodwill, so on that goodwill you have to carry out impairment review. Same for intangible asset. If that intangible asset is not being amortized and it has an indefinite useful life, then only you need to carry out an impairment review. Otherwise, you just amortize it. You don't go for impairment review if it has a definite useful life and it is being amortized. Otherwise, an impairment review is required only when there's an indication impairment may have occurred. See, in this two situation, you need to carry out an impairment review. Okay, if these two situations are not there, then the impairment review you only need to carry when there's an indication of any impairment. Those indications could be external or internal. Okay, you need to know this. Sometimes in exams they directly ask you what are the external source of impairment, what are the internal sources of impairment. External sources means outside, external factor. Like, let's say there's an unexpected decrease in the assets market value, something which you cannot control, right? Or there's a significant unfavorable changes that takes place, maybe technological change or economical change or legal environment has changed, or there's a decrease or increased interest rate. If interest rate increases, your assets recoverable amount reduce. Okay, or the entity's net assets are measured at more than its market capitalization. These four are external sources of impairment. Conditions that say that impairment has taken place, but they are not in your control. So in your exam, you need to see whether these four conditions are there or not. One of these four are there or not. If one of these four are there, it's an external source of information. If it's not there, then you need to look for internal. Internal means something which you can control, which is inside the organization. Like maybe your asset is damaged, or maybe it became outdated, right? Or there's a material reduction in the usage of an asset. You have to see for this also. Or there's an evidence that economic performance of that asset is worse than expected. You see, so whether external or whether internal, if any of this are present in the scenario given to you, then you can say impairment has taken place. Okay, next question is, how do you calculate the impairment loss once you have passed the impairment review test and you have came to you realize that there's an impairment? This is how you calculate. An impairment occurs, you need to remember this, if the carrying amount of an asset is greater than its recoverable amount. Okay, not the other way around. Carrying amount has to be more than recoverable amount. Okay, now recoverable amount is the higher of fair value less cost to sell and value in use. You need to remember all this. Okay, all these are rules, you need to know it, otherwise you cannot calculate impairment loss. Okay, cost to sell. What is cost to sell? Cost, they will give you all this thing. They will give you the fair value, they will give you cost to sell, they will give you value in use. You have to see which of this are higher. That will be the recoverable amount. Then you compare it with carrying amount and see which is higher. Cost to sell means any cost that is directly attributable to the disposal of an asset, not just any cost. It has to be there for the disposal of that asset. Value in use. Value in use means you are discounting your inflows and outflows, discounting your cash flow, future cash flow. If fair value less cost to sell is higher than the carrying amount, then understand there is no impairment. What did we say earlier? If carrying amount is more than the recoverable amount, impairment is there. But if recoverable amount is less than the carrying amount, sorry, higher than the carrying amount, then there is no impairment. Okay? And if fair value less cost to sell is higher than the carrying amount, then no need to find the no need to calculate value in use. You can stop there itself, saying there is no impairment. Now, regarding estimates of cash flow, we earlier told to calculate value in use, you have to estimate the future cash flows. There are some conditions. Number one, cash flow should be based on the reasonable assumptions, and most reasoned budgets has to be used. Second, cash flow, what is there, should be related to assets current condition. You cannot include expenditure to improve that asset or enhance. They are excluded. Third, if there is a cash flow that is more than 5 years, okay, you cannot take it. Extrapolate. Management should extrapolate from earlier budgets and use steady, declining or zero growth rate. Okay, they will not give you more than 5 years and all those things. Okay, it is just for the safe side so that the cash flows are more reliable. Management should assess the accuracy of their budget by investigating why actual is different compared to the forecast. The more accurate the budget is, the more reason the budget is, and if it is based on the current condition, you can rely more on the value in use. Now we'll be doing a question before we move on to recognizing an impairment loss. Test your understanding 8, impairment review. Here you need to discuss whether the above impairment review is in accordance with IFRS standards or not. Okay, so let us read little about this. Here the finance director is asking the accountant to perform an impairment test on the assets for 31st December 2005 using the most recent financial forecast as the basis for value in use. Okay, the realized cash flow for the entity were negative in 2005 and far below the forecasted cash flow for that period. Directors have significantly raised cash flow forecast for 2006 with little justification. The projected cash flows has been calculated by adding back depreciation charges to a budgeted result for the period with expected changes in working capital, and capital expenditure has not taken into account. Okay, you can see that there are lot of faults in this one, right? Okay, but how do you answer this? When you answer this, you need to first list down the rules of IAS 36. What does IAS 36 says about the impairment review? About the cash. This is about value in use. Value in use means you need to talk about cash forecast. Okay. So IAS 36, just now we saw, okay, that there are some rules when you are using cash forecast for value in use. You just cannot use any cash forecast and put it there and then say it's a value in use. It needs to be reliable. Number one. Okay. The cash forecast that you are using needs to be A, reasonable. Okay. B, you have to see the differences between the actual cash flow and the projection. Okay. Difference between actual cash flow and the forecast. Why there's a difference, and if the difference is wide, it's not a good sign. Okay, you need to figure it out why. And then you have to see, management must see the assumptions, okay, whether forecast are based on, they're consistent. Okay, the assumption needs to be consistent with the past. So once you identify this, then you need to see what's happening here. Here you can see, okay, that even though in 2005 it is negative, they have significantly raised the cash flow in 2006 with little justification. So do you think it's reasonable? No, it is not, because they have raised it without justification. They don't have any justification why they raised the cash flow suddenly. Because in 2005 it was negative. Then why did they raise it in 2006? No justification. So this questions the reliability of the forecast, isn't it? It puts a question mark in the reliability of the forecast, cash forecast. In fact, IAS 36 says about cash flow, right? That any cash inflow, okay, projections of cash inflow from the continuing use of the asset has to be included. When you're continuing with that asset, what is the cash inflow? Second, whatever the cash outflows that are incurred to generate that cash inflow from the continuing use of the asset. Maybe you might have to incur some expenses to keep that asset into that reasonable in their current condition. Those cash inflows or outflows needs to be included in the cash flow projection, right? So any day-to-day expenses to keep that asset in the current condition needs to be there. But here they have excluded capital expenditure. They have not taken, right? So it's highly unlikely that they will not incur an expenditure. They will incur. They need to incur an expenditure, right? But they didn't include those cash flows. So it seems that this is not in according with IAS 36. Okay, finally you need to conclude what's happening, whether it is in line with IAS 36 or not. So this impairment review seems like it's not in line with IAS 36, because the cash flow projections that are used, okay, you can see they are overstating. In short, in summary, they are overstating. That means they are showing more cash flows. That means they are overstating the recoverable amount. If the value in use increases, means overstating recoverable amount. If they overstate the recoverable amount, what happens? You can say there is no impairment loss, or they can reduce the impairment loss. So if no impairment loss means you are increasing your profit. By showing no impairment loss means you are artificially increasing your profit. You are manipulating your financial statements. You see, this is why you need to comply with IFRS standard very strictly. If you don't, you are manipulating. Now we are moving on to recognizing the impairment loss. Now we are moving on to recognizing an impairment loss. Okay, so impairment losses are charged in the statement of profit and loss and other comprehensive income. Okay, but usually impairment loss goes to profit and loss. But if your asset has been previously being revalued upwards, there's a revaluation that took place. Okay, then any impairment is first debited to the revaluation reserve, and it is debited to the revaluation reserve until that revaluation reserve becomes nil. You see, you can reduce your impairment loss up to the amount of that revaluation reserve. Once it becomes nil, the excess impairment loss goes to profit and loss. If you're not understanding this at the moment, it's okay. When we do question, you will understand it. Okay. And once you reduce your impairment loss, okay, then the remaining carrying amount of the asset is then depreciated if it's a tangible asset, or amortized if it's an intangible asset, over its remaining useful life. Now let us do a question before we move on to cash generating units. Test your understanding 9, impaired asset. In part A, you need to discuss the accounting treatment of the above. And in B, how would the answer in part A be different if there was a balance of 10,000 in other components of equity relating to the prior revaluation of the specific asset? Let us first finish with A. Okay. So on 31st December 2001, entity noticed that one of its items of plant and machinery is often left idle. On this date, asset has carrying amount of 500,000, fair value is 325,000, estimated cost to sell is 25,000. You can understand that carrying amount is more than the fair value less cost to sell, because fair value is 325. Okay, if you deduct anything by 325,000, it will be less than 500,000 only. So in short, impairment, it has been impaired asset. If the asset is not sold, then the entity estimates that it will generate cash inflow of 200,000 in each of the next 2 years. Okay, discount rate is 10%. You need to do, you first need to find out the recoverable amount. Okay, first step in your this thing. Okay, step 1. Recoverable amount. This is the first step you need to do. So in recoverable amount, it is higher of fair value less cost to sell, A, or B, value in use. That means if you keep the asset, what is the value you are getting? And if you sell, then fair value less cost to sell. So now, first we'll find the fair value less cost to sell. Fair value is 325,000. Okay. Cost to sell is 25,000. So if you deduct both, it is 300,000. Value in use, you need to find out the cash flow and you need to discount it and find the present value. So it is year 1, year 2. Cash flow is 200, 200. Okay, 200,000. Right? Isn't it? Yes, it's 200,000. Discount factor is 10%. 10%. Okay, 1 divided by 1.1 to the power 1, 1 divided by 1.1 to the power 2. Now find the present value. 182,000, 165,000, add both, it is 347,000. Which of the two is higher? Is it 300 or is it 347? 347 is higher, right? This one. So we are choosing this. This is the recoverable amount. And if you see, carrying amount is 500,000. It's more than the recoverable amount, which is 347,000. So impairment has taken place. Okay, the difference is the impairment. 500 minus 347. Okay, so it is 500,000 minus 347,000. Not always an impairment occurs. Okay, you need to first find out impairment has taken place or not. Once it has taken place, then you calculate the impairment, and it is the difference, which is 153,000. This is the impairment. And how do you charge it? You debit it in the P&L account in the normal situation when no revaluation has taken place. Debit P&L 153,000. Credit where? In the asset. PPE 153,000. Okay. This is how it goes. Now coming to part B. Imagine already 10,000 was there in the revaluation reserve. You have revalued this asset. Then what do you say? Still the asset must be written down to 153,000 only. Nothing changes with this. Writing down is same. Impairment is same. But the way you recognize it in the P&L is different now. How? See, now you have 10,000. So in your other comprehensive income, you can only reduce it up to 10,000. The balance, which is 153,000 minus 10,000, this goes to P&L. 143,000 you are going to reduce it from P&L. Okay. So you debit P&L 143,000, the excess, and you debit other comprehensive income OCI 10,000 up to the amount of 10,000. More than that you cannot, because you have to make it nil, and you credit PPE 153,000 only. So only this changes. Earlier the full amount goes to P&L. Now up to the amount of revaluation it goes to other comprehensive income. The balance goes to profit and loss. That's the only difference. Now we are moving on to cash generating units. Cash generating unit. Okay. Sometimes it is not possible to identify cash flow that is relating to particular asset. That means you cannot say from this asset itself only you are recognizing cash flow. Okay. For example, let's take a production line in factory, right? It is made up of many individual machines, but the revenue that you earn from it, earned by the production line as a whole. Okay. When you recognize revenue, it is taken as revenue earned by the production line as a whole. You didn't say from this line this is the revenue, from this line that is the revenue. No, it's as a whole you recognize the revenue. So in this case, value in use that you are calculating, it is not for one particular asset. It is calculated for group of assets. So that group of asset is known as cash generating unit. Okay, and cash generating unit is the smallest group of assets that can generate independent cash flow. That means from that you can earn revenue. Okay. So in your exam, your task is to identify the cash generating unit. It is not a difficult task. You'll be able to do it. Let us do a question on this before we move on to how to allocate. Test your understanding 10. Cash generating unit. You need to identify the cash generating unit, whether A, B, and C. Okay. Please understand, this is only for you to understand what is cash generating unit. Okay, when you first start studying. But in your SBR exam, you will never get a question straightforward like this. Identify cash generating unit. Okay. You have to know what is the cash generating unit and you have to do the calculations. That is only expected from you in your SBR exam. This is only the beginning stage. Okay. So this easy questions you will not get. Okay. Anyway, let's read. An entity has three stages of production. A is into growing and felling trees. B is creating parts of wooden furniture. C assembling the parts from B into finished goods. Understand. Cash generating unit means that can generate independent cash flows. Okay. So the output of A is timber, and it is partly transferred to B and partly sold in an external market. You see, they can sell. A can generate cash inflow because they can sell to B or in the external market. If A did not exist, B could buy its timber from the market. So the output of B has no external market and it's transferred to C. Output of B has no external market. That means B cannot generate any cash flow independently. They need to transfer it to C at an internal transfer price, right? C sells the finished product in an external market, and sales revenues achieved by C is not affected by the fact that the three stages of production are all performed by the entity. Okay, so let us go by A. A can be a cash generating unit. Yes. CGU. Why? Because it can generate cash inflow. Okay. What about B? What about B? B alone cannot be a cash generating unit, but B and C together can form a cash generating unit. They can form one cash generating unit because B is going to transfer it to C, right? Because there is no market available for B. Whatever it makes, it has to sell it to C. It has to transfer it to C only. Understanding? So when B is selling to C, okay, the cash outflows that you are creating, that you are generating, should be based on the market price, should be based on the market price, reference to the market, not the transfer price, cash outflows. Okay, you must be calculating cash outflows from cash generating unit, like how you do for asset. So in that, you need to make the reference to the market when you're taking the price, not the transfer price, internal transfer price for B and C. So that's it. Now we are moving on to the next part of cash generating unit. Allocating assets to cash generating units. Okay. Now, we told that cash generating unit is the group of the smallest asset. Okay. But you need to know how to allocate assets to cash generating units. Not all assets can be taken in cash generating units because not all assets generate cash inflows independently. Okay. Only those assets which generate cash flow independently, you can take it, you can allocate it to cash generating units. Okay. So how do you determine the carrying amount of the CGU, cash generating unit? Okay, the carrying amount of cash generating unit includes the carrying amount of assets that can be allocated to cash generating unit, and then will generate future cash inflows used in determining the cash generating units value in years. Okay, if you're not understanding all this, it's fine. Okay, just know that normally how do we do? We find the carrying amount of the asset. Okay, then we find the fair value less cost to sell or value in use of an asset. We find the higher of these two, which is the recoverable amount. We find the difference with the carrying amount, and that's the impairment. Same way for cash generating unit, rather than going for one single asset, okay, we allocate assets to cash generating unit is like a group, and then we do the same way, find the carrying amount, then value in use, and compare and see the impairment. Okay, there are two problems here. Number one, corporate assets. What are corporate assets? See, assets that are used by several cash generating unit. For example, head office building, or a research center. They are used by many assets that are you know assets that are used by several cash generating unit. This all are cash generating unit. But since they are used by different many as they are used by different cash generating unit, you do not know how to allocate. It becomes very difficult to allocate the assets to cash generating unit. That is known as corporate assets. In this case, they do not generate their own cash inflows, so do not themselves qualify as cash generating unit. You cannot say a research center is earning cash inflow on its own. No, research center is used for something else. Okay, some other department is using that service of that research center to get that cash inflow. Understanding? If you just take the research center alone, research center on its own cannot generate cash inflow. There is no use of it. So that's why cash research center cannot be a cash generating unit. Second is goodwill, which does not generate cash inflows independently of other assets. Goodwill is only good when it is used along with other assets. Then it can generate cash inflows. Goodwill on its own cannot generate cash inflows independently. Goodwill relates to the whole business, right? So that's why corporate assets and goodwill, when you allocate it to cash generating unit, it should be allocated on a reasonable and a consistent basis. Okay, a cash generating unit to which goodwill has been allocated must be tested for impairment annually. if you are allocating any goodwill to cash generating unit, you have to test it for impairment. Cash generating unit is nothing but group of assets. Rather than you are finding for one single asset, the impairment, you group all the assets in the, it is known as cash generating unit, and then you find the impairment. Okay. Now, allocation. Okay. So according to IAS 36, if there is any impairment loss that arises in respect of cash generating unit, then you have to allocate the assets in this order. You have to remember this order, by the way. You cannot change this order. Okay. This is the rule of IAS 36. Number one, first goodwill. First, you have to allocate goodwill to cash generating unit and then other assets. And those other assets are in proportion to their carrying amount. Okay. We'll be doing question shortly, right? However, remember, the carrying amount of an asset cannot be reduced below the highest of. That means this is the highest you can reduce. More than this you cannot reduce. Highest of this three things. Number one, fair value less cost to sell, value in use or nil. That means your carrying amount of an asset, okay, cannot be less than nil. It cannot be negative. It cannot be reduced below the highest of. You have to see out of this three which is the highest, and you can only reduce up to that amount, the carrying amount of an asset. Now we'll be doing question on this before we move on to the reversal of impairment loss. Okay. Illustration 3. Here you have an impairment allocation within CGU. Okay. How the impairment loss is allocated to assets within the cash generating unit. Okay. So you have been given the impairment loss of 41 and the carrying amount of the unit's net asset was 150. You can see it's 150. Okay. And the recoverable amount is 109. You have been given goodwill, property, machinery, vehicles, patents, net monetary assets. Now, the net selling price of the unit's assets was insignificant except for the property, which had a market value of 35. Net monetary asset was realized in full. Okay. Remember our first ruling, impairment loss will be allocated first against goodwill. Okay. So that means goodwill will be nil. You understanding? So out of this impairment loss 41, you are going to reduce 13 because you are first going to allocate it against goodwill. So 41 minus 13. Okay. Goodwill will be nil, but the balance, okay, when you deduct the 13 from 41, the balance of impairment loss will be allocated for the other assets in proportion to their carrying amount. Okay. Now we'll go one by one. Okay. Goodwill is over. Now starting with property, machinery, vehicles, patents, and monetary assets. Starting with property. You cannot set off against property. Why? You cannot set off your impairment loss against property. Why? Because its selling price, okay, is 35. Selling price is more than the carrying amount. So when your selling price is more than your carrying amount of the asset, there is no impairment. That means property has not been impaired. So property you have to leave. Coming to the machinery. Yes, machinery you can do, vehicles you can do, patents also you can set off. Coming to the net monetary asset. You cannot set off against net monetary asset also. Why? Because they told it has been realized in full. Net monetary asset will be realized in full. So there is no impairment. So this is also just two are left out. The three assets are machinery, vehicles, and patent. Now you need to set off. Okay. See, first we are going to, impairment was 41. Deduct your goodwill because you will first allocate against goodwill. The balance is 28. This 28 will be set off against machinery, vehicles, and patent. Okay. How are you going to do for? How are you going to allocate this? See, this is how you need to do. You need to add all these three. 49 plus 35 plus 14. because you want to find the proportion of the carrying amount of machinery out of this three, of vehicles out of the three, of patents out of the three. So this is how you do. 49, okay, this is for machinery. Divide by the total. 49 plus 35 plus 14. And multiply this by 28 because 28 is the impairment loss. You have to allocate this. This is for machinery, M. Okay. So how much are you getting? 14. Let us do for vehicles the same way. It will be 35 over 49 plus 35. Only three assets will be there. Why didn't we include the other assets? Because I told you this no impairment, this also realized in full, goodwill already allocated, so only the remaining three out of this you have to find the proportion. That's why into 28 because 28 is the impairment loss. Okay, and you are getting 10. Coming to patent, 14, 49 plus 35 plus 14 into 28, it is 4. This is how you need to do it. Okay, let's put this in a form of a table. Okay, these are draft values. Impairment loss, and then the revised value. Okay, starting with goodwill. What is the goodwill? It was 13 before. How much was the impairment? 13. Okay, you will take 13 out, so you'll be left with nothing. Coming to property, property was 20. No impairment has taken place, so it's 20. Coming to machinery, machinery is 49. Just now impairment you found out, by proportion it was 14, so you deduct 14, it is 35. Coming to vehicles, vehicle was 35. We have got 10 and we are left with 25. Coming to patents, $14, deduct 4, you are left with 10. And net monetary asset, net NMA, net monetary asset was 19 in the table given. And here also you are realizing it full, so no impairment. 19. Now add up. This will be 150. Impairment is 41 and 109. You see, total impairment was 41. Do you see now? This is what cash generating unit does. It allocates this 41 goodwill to assets and goodwill. And you see the recoverable amount is 109. Net assets is 150. And here you are getting the recoverable amount as 109. You see? That's what. This is how you need to do. Okay, you need to first allocate against goodwill and then against other assets according to their proportion of carrying amount. Now we'll be doing next question. Test your understanding 11. So here also, like the previous question, you have been given the carrying amount of assets. Now discuss with calculations how any impairment loss will be accounted for. You need to discuss as well as calculate. Okay. The factory operates a cash generating unit and impairment review is done. Net selling price is 1.2. Value in use is 1.95. Half of the machines have been blown to pieces, but other half can be sold for at least their carrying amount. Patents has been superseded and now are considered worthless. You see? So immediately, without much explanation, first we'll go to the table. Okay. Discussion part you can do it, but let me show you the calculation part. Okay. So here draft, impairment, and revised. Okay. You have been given all the assets list: goodwill, patent, machines, computer, and buildings. Okay. While through calculation I will explain you, I will give you the reasons. Okay. See, draft figure is this. All of this you can just copy paste. Okay. Except wherever there are changes. Some. Okay. I'm sorry. This is not the draft figure. There are with some this changes with this. Okay. You have to read this. There will be some which are nil. Okay. Some which are reduced. And then you have to take the revised figure. For example, goodwill. Goodwill is 100. Nothing will happen to goodwill. It's 100. Okay. Coming to patent. Okay, regarding patent, they told patent are now considered worthless. Okay, that means it will be nil. It's 0 here, or you can say 0. Coming to machines. Machine is 300, but regarding machine, okay, they told half of the machine has been blown to pieces, but other half can be sold for at least their carrying amount. So you have to take half of this machine. Half has been blown, that's why. Out of 300, you can only take 150. And coming to computer, nothing happens to computer and buildings. They didn't mention anything. So it's 500 and 1500. If you add up, it will be 2250. Coming to impairment, you first need to do it against goodwill, right? Impairment is first against goodwill. So you deduct this 100. So you're left with nil. Okay. Patent, you cannot reduce anything because it's nil. So it will be 0. Okay. Coming to machines. Okay. Machines, they told half of the machine has been blown to pieces, but other half can be sold at least for their carrying amount. Okay. So machine, you can take this 150. It will be 150. Okay. Because already you have taken only half. So impairment is only against this two. When you're taking impairment, you can only allocate against this two. Okay. You have to explain also. You have to write it and explain. Okay. This calculation is not enough because you have been told to discuss. But I'm leaving the discussion part to you. You can write it on your own. Answers are there. You can read it anytime. Okay. You need to explain one by one. When you're explaining, please keep one paragraph each for one word. For example, one paragraph could be for patent, one could be for machines, other could be for goodwill, like that. Okay. Because they told it's worthless, right? So because patent has been worthless, okay, superseded, that means their recoverable amount will be nil. Okay. So because their recoverable amount is nil, you can reduce it up. You can write it down up to nil. You see here? Patent. Patent was earlier 200. Now it's nil. So that means, okay, in your profit and loss account, total of impairment loss will be 200. I'll write here 200. because now it is superseded. That means recoverable amount is nil. So when recoverable amount is nil, so 200 minus the recoverable amount is now 200. So this is the impairment loss regarding patent. Next paragraph, you will be talking about machines. They told half of the machines has been blown to pieces. Other half has the carrying amount. Okay, that means 150. So that means 150 only you can reduce only up to 150. So another 150. So here impairment will be 150. What about other assets? Other assets, computers and building will come into other assets. Okay. You cannot determine the recoverable amount of this too. Can you? See, this is even an explanation you have to write. Okay. First paragraph is about patent. Second paragraph is about machine. Third paragraph is about this too. Leave one line and then explain. See, other assets you cannot determine the recoverable amount. Can you? That's why you have to test this for impairment as a part of CGU. This comes in cash generating unit. It comes together. Understanding? So the total carrying amount of the CGU after the impairment of the patent and the machinery is this. Okay. Now you need to find out this impairment part. And the recoverable amount. See, just wait a minute. Okay. Yeah, you see here. Wait just a minute. So you see that impairment reveals the net selling price. Net selling price means fair value less cost to sell. Okay, less cost to sell. This is the meaning of net selling price. It's 1.2 and value in use is 1.95. You have to take the higher of the two as a recoverable amount. Higher of the two is what? Value in use, which is 1.95. This is the recoverable amount, right? So when you take it with this 1.95, then you can find the impairment. 2600 minus 1950. Let us take it and see. It is 650,000, the impairment. Okay. So this is the total impairment. Out of the 650, you have already allocated 100. You have already allocated 100 to goodwill. So from the 650 impairment, you have allocated 100. You are left with 550. This you have to take account with the carrying amount of computer and building. Okay. Computer is 500. 500 plus 1500 into 550. Let us do that and see. No, there is somewhere there's a mistake. Recoverable amount is 1950. Okay, so first we'll find the recoverable amount. This will be 1950. So since you know this is 2250, 1950, yes, this is how you find the impairment. I'm sorry, 300, the difference. You see, difference of draft and the revised. 2250 minus 1950 is 300. This is the impairment. So out of 300, 100 is gone. So you're left with, cancel this out, you're left with 200. This 200 you have to allocate against computer and building. So it's 200 multiplied by 500 over 500 plus 1500, which will be equal to 50. And if you want to do for the building, it will be 200 multiplied by 1500 500 plus 1500. It will be 150. So this is what you need to allocate here. 50 and 150. If you add up this 300 plus 50 plus 150, it will add up to 300. Okay. So 500 minus 50 is 450. 1500 minus 150 is 1350. What we are doing here is we first found out this and then we are going backwards to find this rather than finding this individually, because we have been given this, the recoverable amount we know. So what is the total impairment? That will go to profit and loss. You need to, in your discussion, you also need to say that first you are allocating against goodwill, then why you're not allocating against patent, machinery, and how you are allocating against computer and building. You need to discuss all this. Okay. So now, what is the total amount of impairment? Earlier, you see, here it is 200 of patent and 150 of machine. Okay, 350. With that 350, you have to add this 300. This is for CGU. So total goodwill will be 600. Sorry, not goodwill. Impairment will be 650, which will go to profit and P&L. 350. Sorry, this 300 comes from CGU, the table which we have calculated here, and the other two you can immediately find out. 200 from patent, 150 from machine, because they told patent is superstated, that means fully, that is impaired. Machine half, that's why. And the balance, goodwill, computers and building, we take it in the CGU, and that's how we add the two impairment and we tell that this is the total impairment which goes to P&L account. Now we'll be doing another question. If there is no reasonable allocation of corporate assets or goodwill, then what do you need to do? Then a group of CGU must be tested for impairment together in two-stage process. Okay. You can see an entity acquires a business that has three cash generating units, D, E, and F. Okay. That's why there's no reasonable way of allocating goodwill to them. How do you know how much of goodwill will go to D or E or F? So after 3 years, the carrying amount and the recoverable amount are given. Okay. Now there are two steps that you need to follow here when you cannot allocate goodwill to the CGU. And you need to remember this. What is step 1? You first need to review the individual units for impairment. Review. Individual units for impairment. So just see D. Carrying amount is less than recoverable amount. So this is not impaired. Here, carrying amount is less than recoverable amount. So this is not impaired. But if you see F, F is impaired because carrying amount is more than recoverable amount. So F is impaired. F is impaired. And what is the loss? See, you can reduce this carrying amount up to 360. Okay, more than this you cannot reduce. So how much it will be? What would be the loss? You can reduce it. You can reduce up to 360,000 the carrying amount. Okay, carrying amount is reduced to 360,000. So how much is it? How much is the impairment? 420 minus 360, which is 60,000, because they sign in thousands. Okay, so 60,000 is the loss. Step 2. You need to compare the carrying amount of the business as a whole, including the goodwill, with its recoverable amount. Okay, I'll write it down. I'll write down it for you. These are very important steps. Okay, compare the carrying amount of the business as a whole, including goodwill. With its recoverable amount. Done. Find out the total carrying amount of the business. Total carrying amount of the business is how much? You see, this is the carrying amount. You deduct 60,000 because 60,000 is the impairment. So it is 170,000 minus 60,000, which is equal to 111,000. Okay, now you see there's a goodwill of 150,000 because they told you have to include the goodwill. Okay, you have to, there's a further impairment loss. How much? You have to compare it with this recoverable amount. Okay, the carrying amount now is 1110 Deduct this with recoverable amount, which is 1080,000, which is 30,000. You see the difference, 30,000. So you have to recognize further impairment loss of 30,000. So that's it. This is how you need to do it in 2 steps when you are given different CGUs and you cannot allocate. You first need to find out for individually, you have to figure it out whether there's an impairment or not. Like in this case, D and E is not impaired because carrying amount is less than recoverable amount, but F is impaired. After it's done, step 2, compare the carrying amount of the whole business, including goodwill, with the recoverable amount. Okay, so these are the 2 steps. Now we'll be moving on to reversal of impairment loss. What happens with it when the impairment loss is reversed? Reversal of an impairment loss. Okay, see, when you're calculating impairment loss, okay, we are predicting it based on what may happen in the future, right? We are calculating the impairment loss today, predicting what may happen in the future. But actual events may turn out better than expected. So in that case, what happens? You need to recalculate the recoverable amount and the previous write down is reversed. You have written down impairment loss, right? You have written down the carrying amount. Now you have to reverse it. When the actual condition turns out to be better than what you expected. You were expecting value of asset might fall down or the market condition would go down, right? Which might affect the value of the asset. But in reality, the actual condition is much better. That means there's no impairment that has taken place. But since you have already calculated impairment loss, now you have to reverse it. Okay. So impaired assets, okay, any impaired assets, now you need to review to see whether there is any indication that impairment has been reversed. That means any indication that condition has improved. If it is so, you have to reverse the impairment loss. And any reversal of impairment loss that was recognized in profit and loss, you have to reverse it. Now you have to write it as a profit. Okay. But if that impairment loss was recognized against the revaluation surplus, then you need to recognize it in other comprehensive income. If it was against just the asset, like without revaluation, then it is profit and loss. You have to write it as an income. If it was charged against revaluation surplus, you have to recognize it in other comprehensive income, the reversal of impairment loss. Okay. But there is a condition. When the reversal takes place, you must not take the value of the asset above the amount that it would have been originally if impairment had never been recorded. That means before the impairment, if suppose there was no impairment, whatever the amount of asset would be at that time, you can reverse only up to that amount, max. More than that, you cannot write down the value of the asset. I mean, when you reverse it, you cannot write the value of the asset above that. Okay. And any depreciation that would have been charged in the meantime, you have to account for it. The depreciation charge for future periods should be revised to reflect the changed carrying amount. You have to change that also because now your carrying amount will change. When you reverse the impairment loss, carrying amount will change. Carrying amount will increase. So you have to charge depreciation also for that. Depreciation also have to change accordingly. And an impairment loss that you have recognized against goodwill, you cannot reverse it in the subsequent period. Remember that. If it is against some asset, then only you can reverse it. Why? You don't have to know the reason, but let me tell you the reason. The reason is, see, the asset, okay, when you're recognizing impairment loss against asset, you can see whether the market is improving for the asset or not. There's an open market for it. You can see whether the conditions are improving or not. But for goodwill, goodwill is very unique. It's very different from one company to a company. There's not an open market. So you cannot understand whether goodwill value went up or down. Therefore, you cannot reverse the impairment loss that is recognized for goodwill. Okay. Reversal is only when the impairment loss is against goodwill, not for goodwill. Sorry, against asset, not for goodwill. Now we are moving on to disclosure. This is the last part of IAS 36 because after this we'll be doing some questions before we summarize. So IAS 36 says that you need to require this disclosure. Number 1, impairment losses recognized during the period. Number 2, impairment reversal. 3, for each material loss or reversal, you have to write the amount and the event what is causing it. The events also you have to mention. Recoverable amount of the asset or cash generating unit. Level of the fair value hierarchy used in determining fair value less cost to sell. For this you have to refer IFRS 13. Okay, there are 3 levels: level 1, level 2, level 3 in measuring fair value. We know that, right? Level 1 is the most secure and most preferred. Why? Because there's a price. Let's say you want to know if your shares are quoted, if your shares are public, you can easily find the fair value. Okay. Level 2, still you can find out for similar, not exact the same price, but for similar you have to do some adjustment. And level 3 is not preferred. It is the most riskiest. It is like you are predicting based on your cash flows. It's like that. So the 3 levels. Okay. And the discount rate used. These things you have to disclose. Now we are moving on to questions. There are 2 test understanding, test understanding 12 and test understanding 13. We will be first finishing test understanding 13 because this is easier than test understanding 12. Okay. So here you have been given goodwill, property, plant and equipment, 2 assets. You have been given carrying amount before impairment, then the impairment, then after the impairment. And you have been told to explain the effect of reversal on the financial statements. Okay. For 31st December 2003. So let's read. On 31st December 2002, you have been given this. Okay. Property, plant and equipment was originally purchased for 400 on this date with a useful life of 8 years. 31st December 2003, circumstance changed. That means reversal has to take place. Now the recoverable amount is 420. So now, when you answer this, okay, you have to start in the order. First, start with the goodwill. Why? Because it is easier to start with the goodwill. Goodwill has nothing to do. You cannot reverse any impairment loss against goodwill. That's why. So goodwill impairment cannot be reversed out of the topic. Coming to the PPE. This, yes, you can reverse it. But you cannot reverse it entirely. It is limited. The reversal is limited to the carrying amount of the asset that it would have been if no impairment has taken place. So for that, we now have to find the carrying amount of the asset if impairment did not take place. So let's do that. Okay. So carrying amount of PPE on 31st December 2003. You need to find out this. Okay. First, you see post impairment. Okay, you need to first find out the post impairment carrying amount. You need to change this also. This was 180, correct? You have to depreciate this. After depreciation, it will be how much? Sorry, it's not this 180, this is this 180. Okay. So 180,000 you minus the depreciation. How much will be the depreciation? 180,000 into how many years? Will it be 8? No, it will not be 8. See, useful life was 8 when it was 1st of Jan. From 1st of Jan 2001, useful life is 8 years. But when you're moving 2 years ahead in 2003, so useful life becomes 6 years now. Okay, so it will be 6. How many? Only for 1 year. You have to minus the depreciation. Why? because this impairment was done on 31st December 2002 and you are finding for 31st December 2003 the reversal took place only for 1 year. So it will be equal to 150,000. Now, if no impairment has taken place, okay, this is if impairment had taken place, okay. This is the carrying amount given to you. You just depreciate and find the carrying amount. Now we have to find out if there was no impairment, what would have been the carrying amount of PPE, okay, on 31st December 2003. So you have to go to the original. Originally you bought it for 400,000, correct? Now you have to depreciate it. So 400,000, you have to depreciate it. 400,000 into how many years? This you bought it on 1st of January 2001. So from then onwards, useful life is 8 years. Okay. So that means for how many years you are calculating depreciation? 2001, 2002, 2003, 3 years. You see here, 31st December 2003. On this date, you want to know the position of the PPA. So 3 years depreciation you are deducting on that cost, and it will be 250,000. So the max that could be your carrying amount is this. If no impairment was taken place, what would have been the amount of carrying amount of PPE? It is 250,000, right? No impairment. So that means this would be your carrying amount of asset. This is the maximum you can increase your carrying amount of asset up to 250,000. Okay. So from 150 you can increase it up to 250. That means the difference. Okay. So the reversal would be how much? 250,000 minus 150,000. The difference. Up to this much you can increase your PPE. That means it's a reversal. Reversal would be 100,000. You write this as a gain in your P&L. This is a gain, isn't it? Reversal is a gain. With this understanding, we are going to do test understanding 12 also. It's the same question. Okay, two impairment has taken place. One is on 31st December 2002. The other one is 31st December 2005. Sorry, it's not two impairment. On 31st December 2002, impairment review has taken place. They gave it the recoverable amount, everything. 31st December 2005, they are saying circumstances that caused the impairment no longer applies, and they have given you the recoverable amount as 40,000 on that date. Okay, and on so Boxer purchased non-current asset on 1st of January 2001 at 30,000. 10 is useful life. At that time, useful life was 10 years. There is no revaluation that took place. Boxer did not revalue. Okay, but on 31st December, recoverable amount is 16,000. Okay, so now we are going to do for 2002, what would be the position? 31st December 2002, when impairment took place. So that 31st December 2002, this is the date when impairment took place. So carrying amount of asset. How much? It was 30,000, right? The cost into how many years depreciation you have to deduct? You bought it in 2001. So 2001, 2002. 2 years depreciation you have to deduct out of 10. That means you will be left with 8 years, which is 24,000. This same thing you can do it in 2 steps. Okay, if you're not understanding why it's 8 over 10, it's the balance. You can do like this: 30,000 minus 30,000 into 2 divided by 10. 2 years depreciation you are deducting from 30,000, or straight away the balance. Rather than deducting the 2 years, you find out the balance, which is 8 years. Okay, what would be the carrying amount? In one go also you can do like this. Then the recoverable amount is given as 16,000, isn't it, on that date? So find out. So impairment is 8,000. Impairment loss on that date, right? Now we are moving on to year end 31st December 2005 when reversal took place. You need to find out the assets carrying amount. Assets carrying amount will be on that date will be, okay, how much? You have to recalculate the recoverable amount. Okay, see here, wait just a minute, what did we do here? They have given the amount, right, after you deduct impairment on 180. Yes, so here on the 16,000, okay, like how you have done for this, you see here, this was the impairment, not recoverable amount. So after you deduct the impairment, you found out this one. Basically this is a recoverable amount, 180, right? You have depreciated, you have found out the depreciate after you deduct the depreciation from that amount. Same way you have to do for this also. On this recoverable amount 16,000, you have to minus the depreciation out. Okay, so it will be 16,000 into, when you're coming to 2005, it will be 8 years. Okay, understand this. When you're in 2002, okay, wait, yeah, so on 1st of Jan, from Jan 2001, useful life was 10 years. Okay, when you are in 31st December 2002, it is 8 years useful life. But when you're coming to 31st December 2005, you have to reduce another 3 years from 2002 to 2005, 2003, 2004, 2005. That's why the useful life is 5 years. I'm sorry, it is 5 years. That means 3 years depreciation you have to deduct. Useful life will be 8 years, I'm sorry, yes. You have to reduce 3 years of depreciation, 2002, 2003, 2003, 2004 and 2005. So the balance will be 5 years. Okay, which will be 10,000. Recoverable amount is 40,000 because they told 31st December 2005, this is the recoverable amount. Recoverable amount is more than carrying amount, so impairment is nil. Nil. But you have to explain this also. You see, there is no impairment loss. There has been a complete reversal of the first impairment loss. Now, you have to find out the reversal amount. How much you can reverse. For that, you have to find out, okay, what is the value of the carrying amount of the asset if impairment did not take place. So originally you bought it at 30,000 with useful life of 10 years. So in 31st December 2005, after 5 years, you have to find out. That means you depreciate 5 years and then find out. So from 30,000, okay, you deduct 5 years worth of depreciation, and then you find out the balance is 5, so it's 15,000. So you see your carrying amount is 10,000. Okay, that means with impairment, if impairment took place, okay, you depreciated it, it would be 10,000, the carrying amount. But if it was not impaired in the first place, the carrying amount would be 15,000. So from 10 you can increase to 15,000. So reversal will be 5,000, the difference from 10 to 15. This is the reversal of the loss. You have to write this in the P&L. Understanding? It's the same how we have done for test understanding 13, sorry. If you see, you will see from here, you see, from 150 to 250. So the difference is the gain. Difference is the reversal. Here also 10 and 15. The difference is the reversal, 5,000. But if you see, the original impairment was 8,000. But you couldn't reverse the full 8,000. We could reverse up to 5,000. Why? Because IAS 36 says impairment can only be reversed to a maximum amount of a depreciated historical cost. That means if your amount was not impaired, on that you depreciate and find the carrying amount, up to that amount you can reverse. That's why that's the max, which is this. Once you find the difference, 15 and 10,000. So the max is 5,000. More than this you cannot reverse. This is the law. So that's it. Now we'll be summarizing IAS 36. So let us summarize IAS 36 now. We started with indications, whether impairment takes place or not. There are both external and internal factors. External are outside the environment, outside your company, which are not in your control, and internal is inside the organization. Calculation. Carrying value less recoverable amount, and recoverable amount is higher of the fair value less cost to sell or value in use. Okay. Cash generating unit. This is the smallest group of assets that generates independent cash flow. Regarding goodwill, if there is any impairment loss, you first have to allocate it against goodwill and then against other assets in proportion to their carrying amount. This order you have to remember. And if reversal takes place, any reversal is immediately charged as income in profit and loss, and any impairment loss that is recognized for goodwill, you cannot reverse it. So that's it for IAS 36. We'll be moving on to the next standard, that is IAS 37, provision, contingent asset and contingent liability. Thank you for watching, and meanwhile don't forget to subscribe to my channel if you haven't subscribed, so that you stay notified with my latest video updates. Thank you.